Hello friends, welcome to the channel. In this video, we're going to do a comparative analysis of the three stocks in the trillion dollar club: Apple, Microsoft, and Amazon. The figure $1 trillion is an insanely huge number. I'll have to think for a few seconds to realize the number of zeros in the figure. It is an extraordinary valuation. If you rank the market cap of these three companies against the GDP of the countries in the world, they are behind only the US, the European Union, China, Japan, and Germany. That's just insane for three companies with a few 100,000 employees. These are three unique companies with different products, different revenue models, and growth potentials. This video tries to introduce the financials behind these three companies and aims to try and see the rationale behind such an extraordinary valuation of the three companies. Before going further, I probably want to apologize for the poor Photoshop work which I have done. Hopefully the analysis is going to be better than this work. So let's quickly jump into the analysis. And also, a small disclaimer, this is not so much of a fundamental analysis of the stocks, but it's a bird's eye view to try and make a sense of the valuation. Oftentimes we don't really have so much time to do a complete fundamental analysis of the company, and probably we have to give the best estimate with this little time we have. And this video is precisely that. Also, this is not an impact analysis of COVID-19 on these three companies. Frankly, I doubt if anyone can do this at this time. So I'm just going to act as if COVID is not there and why the valuation of these three companies are so huge. So to arrive at this, to make this analysis, I put across the profit and loss statement of the three companies from the SEC filings announcing FY19 financials. The difference of these three companies, Amazon, Microsoft, and Apple, is immediately evident in the revenue and the operating margin. Amazon makes the most of the revenue at $280 billion. It is very understandable because Amazon sells almost all the products under the sun. On a daily basis, it has millions and millions of people purchasing products ranging from stationery to laptop to clothes to shoes in this portal. What is stunning is Apple is coming close second on the revenue race. Apple sells only 4 or 5 products, right? And to rake up $260 billion of sales from these products talks volumes about the company. Microsoft is at a distant third at $125 billion sales. What Microsoft loses in the revenue battle, it romps home on profitability. The company generates almost 35% operating margin and hence bridges the gap between the companies Apple and Amazon. Apple, which is required to kind of manufacture every product it sells, operates at 25% margin, and Amazon is, at the end of the day, a core business is only a marketplace, is at a margin of 5%. The profit after tax trend looks similar to operating margin. Apple is ahead, generating $55 billion of profit after tax. Microsoft is not too far behind at $40 billion. Mind you, they've generated almost less than half of what Apple has generated in terms of top line, but PAT is not too far behind. And Amazon is a distant third at $11 billion. Between these three stocks, Apple looks the cheapest, trading at 21 times its earnings. Microsoft is at 27 times price multiple. Amazon is at a humongous 89 times price to earnings. On the face of it, Apple looks the most conservatively valued stock, while Amazon is an outlandishly overvalued stock. Let's kind of dig into these companies for a little more detail. Let's start with Microsoft. Microsoft records its performance in three business segments. Number one is productivity and business processes, which primarily has the Office 365 product, the Skype under it, the Outlook, LinkedIn, and the ERP solutions which it offers to businesses under it. The second business segment is the intelligent cloud, where it has Azure, it has the software development platform, GitHub, it has the Windows Server, which is primarily the legacy business which Windows used to have for so long. The third is the personal computing segment, where the Windows software per se, the commercial and consumer software, the devices, the Surface Pro, the personal computer devices, the gaming, which includes the Xbox acquisition, is under this. It looks to be a very stable company. If you look at these three segments, all three segments record a really healthy margin, and revenue-wise also, this 125 billion dollar revenue is kind of evenly spread between these three models in an equitable fashion. It also sum it up. Microsoft looks a very stable company with diversified business under a leadership which knows what it's doing. In between, in the early 2000s to end of 2010, it looked like it had lost the plot under Steve Ballmer. They were chasing the mobile phone market, which it had already lost, piling up multiple failure acquisitions under its belt, including the very famous acquisition of Nokia. Now Microsoft seems to have built a strong set of segments for itself and is operating within those segments. The three business segments it reports are operating at 30% and above margin, which speaks a lot about how far the company has evolved. Now let's take a look at Apple. Apple makes extraordinary products, which are so beautiful and well interfaced. I'm a huge fan of their products and happen to use an iPhone and Apple Watch. I also use an iPad and pencil, which makes a great pair for studies and note taking. From a valuation point of view, company looks like a one-trick pony. I'll tell you why I think so. Apple has 5 segments, which are basically the products they sell: the iPhone, the Mac, iPad, wearables and accessories, which is basically the Apple Watch and the accessories, and services, which basically makes the 5 business segments in which they operate in. But when you dig deeper, you realize more than half of its revenue is coming from iPhone sales. $142 billion of the $260 billion it generates is from iPhone, which is declining actually. iPhone sales during FY19 dropped 14%, which is kind of reflective of what is in store if the company, what is in store for the company if it doesn't come up with something new. The company has done well in the past in terms of introducing new products by launching the Apple Watch, the iPad Pro, and more recently the iPad with the mouse option. But the company is still relying too much on iPhone sales, and it seems to have hit a ceiling in innovation and new exciting features. There simply isn't any excitement surrounding a new iPhone launch, which it used to be. Apple is playing with improvements in camera, processor, speed, etc. in the iPhone, but the incentive for people to keep buying a new $1,000 phone every year seems to come down every year. iPhone also has a huge problem of competitors. Apple may find it increasingly difficult to justify selling a $1,000, $1,500 phone with no major upgrade compared to Xiaomi's and the OnePluses, which sells very similar product at 50 to 25% of the cost. Apple has been category creators with their iPods, the iPhone, iPad, Apple Watch, etc. And they need to come up with something new in the coming years to sustain the level of financials it's posing today, and hence sustain the stock price also. This risk is reflective in the way market has valued the stock. Apple is the cheapest of the 3 stocks, trading at 21 times earnings. Let's move to the third company that we are looking at in this video, Amazon. Amazon is a different to the rest of the stocks. It has 3 streams under which it reports its revenues. Number 1 is the North America Amazon.com business, which generates pretty much some 60-70% of its total revenue. It generates $170 billion of the total revenue that Amazon makes. Second is the international e-commerce business, whatever they do in China, India, Japan, the Europe. So basically, it's the non-American Amazon business, which records $74 billion. Third is the innovative AWS, the cloud, Amazon's software as a solution AWS cloud platform, which generates $35 billion. Between the 3 segments, obviously AWS is the leader in terms of operating margin, generating 27% margin. Amazon.com generates around 4% margin, and international e-commerce is still making operational level losses. Amazon today trades 90 times its earnings, which will make you think it's extremely overvalued stock. On a closer look, you'll realize Amazon has always been valued at such multiples over the past, and the company has been delivering on the growth targets the stock promised to provide. If you look at the PE of Amazon stock over the last 5 years, its PE is lowest now and was trading at 1000 times earnings in 2016. With Amazon, the idea is the company is expected to grow at extraordinary levels, say 30% on top line, and the expectation is that the margins should improve from the current 5% to 10% over time. Amazon has delivered on all these parameters during the last so many years, moving from operationally loss-making company to company generating 5% margin on such a large base. Amazon's sustenance of this share price depends largely on its ability to grow at 25% to 30% on top line and improve its margin from the current 5%. I'd like to show you the movement of the stock of these three companies during 5 years, which summarizes the discussion. While Amazon and Microsoft have grown strongly over the last 5 years at a CAGR of 9% and 7%, Apple has kind of been behind the curve, growing only at 3%. In my view, this is how the market is going to perceive these three companies in the future also. That Amazon is probably the ultra growth stock, while Microsoft is going to be this mature and still has growth potential, while Apple is going to be this mature and stable stock. Having done this review, I'll conclude this in as many words. If I had to choose between these three companies, I'll probably go to Microsoft, given the profile and the various things we discussed, and also most importantly, my risk profile. Also, please understand, this is not so much of a detailed valuation of these three stocks as I told earlier also. A thorough review of the value behind the stock would require us to dig deeper, analyzing the free cash flow to equity, and probably have an appropriate growth projections in the future and discount the FCFE to today's value. But in today's time where we really don't have time to do this, what we get to do instead of doing that is probably put our best foot forward. This is exactly that. Yeah, that's pretty much. Thanks for watching the video. Hope you enjoyed it. What do you guys think? Please do leave a comment with your views and analysis. I'll be very happy to see it. Thank you.